We just got news that the job market wasn't too hot in July. That obviously wasn't good news, but then it got worse. The Bureau of Labor Statistics said that our job market in May and June in 2025 was even worse than we originally thought. The reports initially said that in May we had 144,000 jobs added in the United States. In June it was 147,000 jobs, and then July, which was not good, was 73,000 jobs. But then it turns out that this number was wrong and this June number was wrong. In actuality, in May, only 19,000 jobs were added, and in June, only 14,000 jobs were added. This job market news then caused a chain reaction. First, we saw the stock market take a hit because investors got concerned about the economy. Second, President Trump then fired the head of the Bureau of Labor Statistics, saying that these numbers were wrong. And third, all eyes and pressure goes back to the central bank, the Federal Reserve Bank, to say, will you be cutting interest rates sooner rather than later to stimulate the economy? In this video, I'm going to break down what's happening in the job market, what might be coming in the job market so you can prepare, and how this creates investment opportunities that you might not expect. 2025 has been an interesting year because not only have we been seeing an uptick of layoffs, but we've also been seeing some of the highest bankruptcies that we've seen since the end of the 2008 Great Financial Crisis. Why is this happening? Well, it's partially to do with higher interest rates. It's partially to do with AI and technology shifts. It's partially to do with tariffs, and it's partially to do with changes that we're seeing in the economy. I'm going to talk more about this in just a second, but this is where I also want you to be a little bit more scrutinous when you see economic data or jobs data, because take a look at this. This is a chart showing unemployment rates in the United States for the last 10 years, and after the big pandemic spike in unemployment, things look pretty good. These low unemployment numbers are why so many economists say that a job market is still extremely strong. But you have to dig a little bit deeper, because if you ask the average person on the street how's the job market, they will tell you that the job market kind of sucks right now. For many people, not all people, but for many people, getting a job is harder right now, while we've been seeing wage growth cooling pretty steadily over the last few years. Which means over the last few years, we went from a job market where employees had all the power to now a job market where employers have more power. What caused this shift? Well, it was these four things right here, starting with interest rates, because in 2020, the Federal Reserve Bank cut interest rates to their lowest levels ever. During that time, employers were desperate to find labor, so they were offering huge raises, huge sign-on bonuses, and huge perks just to incentivize you to come work for them instead of their competitor. It was a great time to be an employee because you had all the power, and this led to the Great Resignation, where millions of employees said, hey boss, pay me more money because everybody wants to hire me. But then this power dynamic started to shift in 2022. I just showed this chart to you, but this is the Federal Reserve Bank's wage growth tracker, and you can see that wage growth really peaked right here in 2022. So 2022 was when the Great Resignation started to slow down. That was when wage growth started to cool. But what triggered all of that? Well, take a look at this. In 2022, the Federal Reserve Bank started raising interest rates, which means if you run a business with debt, your business got a lot more expensive to run. And remember, the Fed didn't raise interest rates just one time, they raised interest rates 11 times, which means doing business with debt got a lot more expensive, and borrowing more money got a lot more expensive, which changed the economy and it changed the job market. And that was the first trigger to start shifting this equation. But this is where the effect of those interest rates do go a little bit deeper now in 2025. But this is where I also want to remind you that if you're an investor, I'm hosting my biggest investor workshop of the year on August 12th to help you understand how these changes create investment opportunities. It is a completely free workshop. I'm going to be going over how you can find investment opportunities in a Trump presidency through an economy with changing technology, changing AI, through all the geopolitical shifts. So if you are an investor and you want to understand how you can invest your money better, find hidden investment opportunities in 2025 that a lot of people might be overlooking, this is going to be an amazing workshop where you will find a ton of value. Again, I'm doing it twice on August 12th live. I'm doing it at 10:30 a.m. Eastern Time, and then again in the evening at 8 p.m. Eastern Time. So if you'd like to join me, please make sure you register because there's a limited number of seats, and this is my biggest workshop of the year, and we've always hit capacity. So if you'd like to join me, I have the link for you to join down in the description below. Businesses don't get 30-year fixed rate mortgages. Instead, they're generally seeing 3 to 7 year loans that then readjust. And during the 2020 pandemic time, pretty much any business with debt refinanced their businesses with as much debt as possible because you could get a loan for essentially 0% interest. Well, here we are now in 2025, and a lot of the debt is now starting to come due, which means businesses that borrowed huge sums of money at essentially 0% interest rates are now starting to see those debts come due, meaning readjust at a much higher interest rate, which means if you're a business that has debt, yes, your expenses have gone up. Not just because salaries have gone up, not just because rent costs have gone up, not just because every other cost has gone up, but also because now your debt is going to be readjusted at a higher rate, which has been slowing down the economy for businesses and the job market. But then we also have artificial intelligence and the shifting in technology. Now, if you ever used ChatGPT before, you know that in just the last couple of years, ChatGPT has gotten a whole lot smarter and it can do a whole lot more things. And because of the growth in AI and how fast it's growing, we've been seeing AI replace thousands of jobs now every single month. And nearly half of all companies around the world have said that they're going to implement some sort of AI into their businesses and will likely reduce some sort of jobs because of the AI. Now, I don't think the AI is going to be disastrous for the job market like a lot of people expect. I do think it's going to take some jobs, but you have to understand how AI is changing the dynamic for the business and job market. I mean, a few years ago, we were looking at creating an app for Briefs Media. And to custom code that app, it was about $250,000. That was a total bid for everything we wanted to do. This is pre-ChatGPT time. Well, now we got another bid for a very similar app to do. And the price of building this app, because we can supplement the human developers with AI developers, is about $25,000. So we're talking about a 90% discount in just the last few years because of AI. Then we have number 3, which are tariffs. Now, tariffs have been a very hot topic in 2025 because President Trump has unleashed a tidal wave of tariffs on countries around the world as soon as he entered the White House. And yes, tariffs will have impacts on businesses and how companies run and do their businesses, but we don't know the exact impact of that just yet. However, the part that we do know and that we have seen is that because of the uncertainty of these tariffs, many businesses have decided to slow down or control their investment into their own businesses because of the uncertainty because of tariffs. The reason why that matters is because if a business decides not to invest money into opening a facility, to opening a store, to opening some research and development, that means that people are not getting jobs, not because the opportunity is not there, but because the business is concerned about uncertainty, so they wanted to hold on to that cash. Now, hopefully, as we start to iron out more of these tariff details, that money will then start to be unleashed, because then businesses will say, okay, we understand now what tariffs are going to do. We have less uncertainty, so now we'll feel more comfortable actually investing our money again. We'll see what ultimately happens with that. And the goal with tariffs is to bring more manufacturing jobs into the United States. And this is where, according to Forbes, we are expected to see a jump in manufacturing jobs because of these tariffs. Now, how much and how many, only time will tell. Everybody has a prediction, but let's ultimately see what happens with jobs because of tariffs over the long run. And so we will wait and see because of that. Which brings us to number 4. The economy. The pandemic started 5 years ago, and in 2020, 2021, and even 2022, there was a lot of free money floating around because of low interest rates, because of stimulus checks, because of unemployment checks, because of PPP loans for businesses. There was a lot of free money floating around, and so people were spending money like anything because, well, there was just a lot of money out there. Today, it is not that case. And so yes, the economy has slowed from the 2021 peak because back then money was just everywhere. Today, people are now starting to have to make some real decisions on how they want to spend their money, because in 2023 and 2024, people kept spending money, even though they didn't have the money to spend because they got used to it. In 2025, well, people are realizing life is expensive. I now have this credit card debt from all this foolish spending that I did over the last couple of years, and inflation has not gone away. The price of things are still going up, not as fast as they were a few years ago, but they're still rising, while wages are not keeping up. And so this is where we've been seeing a general slowdown and more concern when it comes to spending. Now, to be clear, based on the data that we have today, the economy is not slowing, it's just not growing as fast, and spending is not going negative, it's just not growing as fast. But we have to pay attention to the trends. Are we going to continue seeing an economic slowdown into a negative level where the economy is shrinking? Are we going to see spending go into a negative level where spending is contracting? If so, that would lead us into a recession, but we haven't seen that happen just yet. Now, the reason I want you to pay attention to this is for two reasons. Number one, if you are in the job market, understanding what this means for you and for you investors, how does this create opportunity? If you were in the job market, what does this mean? Well, we know the job market is shifting. This is not 2021 and 2022 where you can just go on the street and find a job that's going to pay you 20% more with more bonuses, with more perks. It's not as easy. It is going to be more difficult. So understand that shift. Employers are now realizing that they need to be more profitable. They just can't keep offering free money to everybody. Companies are getting more lean. They have to be more efficient, and they're going to need more productivity. Period. Understand that, hate it, complain, doesn't really matter. I want you to know what's going on. That way you can take better care of yourself, your family, and your community, because if your job is important to you, understand what's going on in the market. The second thing has to do with opportunity. Now, this is going to seem a little bit backwards, but I want you to start thinking like an investor. And what investors are looking at is, hey, when the economy is not so good, that means that somebody's going to have to stimulate the economy. That's what we've been seeing happen for the last few decades. Anytime we see an economic slowdown, the Federal Reserve Bank comes running, they cut interest rates, they stimulate, and maybe they print money. And so the people on Wall Street are saying, if we're starting to see a slowdown in the job market, that's more ammunition for the Federal Reserve Bank to say, that's bad for the economy. We need to stimulate the economy. How do we stimulate? Let's cut interest rates. And so what Wall Street is saying is when we get bad news in the job market, that could create lower interest rates, which could benefit certain stocks that benefit from lower interest rates, because there are certain companies that are primed to benefit more than others when interest rates fall. Like who? Like mortgage lenders, like banks, like real estate stocks. Now again, we don't know when the Federal Reserve Bank is going to cut interest rates. Currently, the Fed is saying we don't want to cut interest rates because we're concerned about tariffs. But if the economy gets bad enough, they might say, because the economy is becoming more of a concern, we have to cut interest rates sooner rather than later. We don't know if that's going to happen, but that's something that Wall Street is trying to predict. In addition to that, we know that President Trump wants to cut interest rates. He's talked about this very openly, and he's essentially made it very clear that when Jerome Powell, who is the chairman of the Federal Reserve Bank, his term ends in 2026, President Trump wants to replace him with somebody who's much more in favor of cutting interest rates aggressively. So if the current Federal Reserve Bank administration doesn't cut interest rates very much in 2025, there's a very good chance that President Trump will bring somebody into the Federal Reserve Bank in 2026 who will be more likely to cut interest rates. So these are the things that you want to pay attention to. Yes, they can create opportunities for investors that understand how this can create a shift in money. But this is also one of those things that I'll be talking about on my workshop on August 12th. Again, if you are an investor and you want to see how you can invest your money better, I'm very much looking forward to seeing you and hosting you on my workshop. Just make sure you register soon. Again, I have the link for you down in the description. America is entering a death spiral.
When debts rise relative to incomes on a chronic basis, right now for the U.S. government, it's almost $1 trillion a year that goes to interest payments. When you run a large deficit, you have to sell debt to do that. And when I calculate it, the quantity of debt sold, to be sold is much